Hello, and thank you for watching our second quarter Feldmeyer Forecast. I'm Ben Feldmeyer. I'm here with my counterpart, Derek Miller. We are recording this broadcast so that you can keep up with what our quarterly message is.
So topics that we plan to cover today, these are the most popular topics that we are getting feedback from our clients about concerns that they have as we head into 2024. The biggest one being it's a presidential election year. So how does that affect things, ultimately leading to potentially more stock market volatility? We'll also address inflation and interest rates that also has some sort of impact on market expectations and ultimately volatility. It all comes down to, do we think there may also be a recession on top of it being an election year? And then with all that being considered, we're going to give you our opinions on what are some market opportunities and what can we do given all the information we're about to go over. So the first one being, what is going on with the stock market and bond market when it comes to presidential elections? And while there's always concerns, whether your person is in office or is out of office and you think they might get in one way or the other, the question is, does it matter who is in, a Republican or Democrat? And history tells us not really. So the stock market has been positive 10 out of 12 times going back to every presidential election to 1976. The only two negative times in the stock market was the tech bubble and the housing bubble. So if we take those out of there, the average, return, even with, I guess, those negative returns included in there, is average rate of return of 10%. And then if we look at the bond market, they were actually positive all 12 years with an average return of 7. So the question is, why is everybody concerned? Well, typically there's a little bit more volatility, maybe slightly less stock market return. So if we look at the election slide here, or the historic performance of the S&P 500, we see this gray bar being the average return on non-election years is 11.6%. The presidential election years were at 9.8%. So really pretty close to each other in terms of performance. Not many people talk about it, but the midterm election years are really the years that we see more volatility, less market performance. Now, something that's interesting to point out on this slide is that light green chart that goes about a fourth of the way through. That is our year-to-date, our quarter return of the S&P 500 so far this year. And what we've seen is we've experienced limited volatility and actually a pretty good return so far. With that, we want to take a look at where is that return coming from. So on our next slide, we're actually going to look at where did the return come in the S&P 500 for last year as well as this year.
Most of us have heard about the 7 stocks, Magnificent Seven, that contributed to so much of the rate of return of the S&P 500 index last year. If we actually look at the top 9 stocks, they were over 100% of the rate of return of the index. That doesn't seem like it can make sense unless you look at the bottom of that chart and you see rest of the S&P 500 a minus 0.2%. So literally 9 stocks were responsible for the rate of return of the S&P last year. If we look to the right-hand side, we see 9 stocks contributing 75% of the rate of return so far this year. The names are a little bit different. Tesla is out. Apple is not there as well. These are not big performers at this stage of the game. NVIDIA still being the one that's carrying the majority of the weight. But we are starting to see some broadening out of the companies that are providing the performance on things, which we could use to see.
So with that being an election year, investors tend to be more cautious leading up to elections. Even if we have cash, we have money that we want to do something with, we're not sure what to do with it or where to invest it because we're not sure if, maybe we think, is our president going to get in or will our president stay in? And we look at it and say, we'll just wait to see what happens with the election and then we'll invest. And what we see is these money market funds, the year of the presidential elections, usually have more money going into them because we're waiting to figure out what the investment opportunity is. And then after that, after our the election's over, the following year, we see equity funds have a lot more money going into them. Um, our whole thing is we should probably stay well diversified and fully invested on any of the existing investments that we have, because as these folks who are putting the money in after the election, that's going to be a tailwind for our own investments that are already invested. Um,
Well, I think one of the reasons money market funds are getting the flows that they're getting, in addition to the election year concerns at this stage of the game, is that the inverted yield curve is providing a high level of return on very, very short term money. So the line across the bottom shows more of a traditional look at things where shorter term investments pay a lower rate of return. The light green line is 2023, and then the blue line, 2024 interest rates. And we see there at the top left hand corner that short term money is paying a very high interest rate at this stage of the game. The problem is that it's short term money, it will not last. So, this is a great place to be parking cash from the sale of something that you're looking to hold on to for a short period of time. But if it's an investment that we're thinking long term, right? We wouldn't want to put IRA money or 401k money or Roth IRA money or anything like that into a money market account because it's not going to hold up.
and we can actually see this over time. We look at what happens on our how much money is in money market funds versus bond funds. And right now, there is about $6.1 trillion in both money market funds and bond funds. And what we see over the next 12 months of performance, if we look at the chart on the right, when this happens, historically, bond funds outperform by more than double. So we're expecting almost a 7% rate of return on our bond funds over the preceding 12 months as compared to the money market of only 3%. And this is ultimately what happens is, yes, short-term rates are higher now, but at some point the Fed will change course. They will start to, reduce rates, and our money market funds, which price daily, are going to drop very quickly. And our bond funds are already going to be well positioned to take advantage of that. So as rates drop, our bond funds should actually go up in value.
Yeah, they'll excel.
Versus our money market funds just losing our yield.
Yeah, we lose the yield, not the share price. So interest rates will come down and performance will be in the bond funds. And that's a 30-year or so history. As 93 through 2024, we've been through these cycles before.
Yep. What are we waiting on for rates to drop from the Fed? Well, there's several things that they look at. Unemployment being one. Inflation's the big one that everyone's keeping an eye on because it affects everybody, right? When we go to the store, when we're buying things, what is inflation doing and is it slowing down? And what we have seen over on the right side of the chart in that green circle is we've had this huge influx of inflation from 21 to 22, where we kind of peaked, and then it has come down. But now that we're close to that, 3.5% to 3%, it's not quite getting to the Fed target, which their target is 2.5%. So they're going to be a little stubborn. Jay Powell spoke this week saying the same thing, which is, we like where rates are. We're watching everything daily. We're going to continue to monitor the data as it comes in, and we'll make adjustments as needed. But for now, I think maybe the market expectations and our expectations here at Feldmeyer Financial Group is definitely in the second half of the year, maybe around the September timeframe.
Higher longer.
Higher for longer.
Yeah, which is exactly what he said yesterday. We've been saying it for 6 months.
So we'll keep an eye out for that. Another thing that we look at is, are we potentially heading into a recession, right? We're not asking, are we in a recession today? We're asking, will we head into one? So we actually want to look at the leading indicators of what is going on. And we see this chart here. These gray bars that we see are historic recessions. And the blue line indicates if the economy is shrinking, if these leading economic indicators are negative, that means we're typically finding ourselves where the economy's shrinking and then ultimately winding up in a recession. So historically, when we've reached about the -10 line is where we've seen start to come in. And what we've seen so far this year, we got to about -7.5, and it's actually started to reverse trend. So we're only down 6.3. I'm going to let Ben talk about the actual leading economic indicators as the index by weight and what that means.
Yeah, on the right-hand side here, we see the weekly manufacturing hours worked, 24%, and a green arrow pointing upward. That does not mean that manufacturing hours worked are up by 24%. The green arrow pointing upward indicates that manufacturing hours worked is increasing. The 24% indicates it's weighting in the index. So it's almost a quarter of the value of the index, which tells us how important of a factor this is. And if manufacturing is staying busy and they're working, that's a good sign. ISM new orders down, consumer expectations, there's concern that could be tied to a number of different things, including the election. But we're getting some mixed signals here. But overall, we're seeing more green arrows than blue arrows, which would indicate we've got a slowing, but maybe not necessarily a real bad recession of some kind.
Yep. Last quarter, this LEI weighting index, over half of the arrows were actually pointing down as blue arrows instead of where we stand today with only 3 blue arrows. So again, it can change as each one of these charts comes out, but it's right now showing as we're improving slightly. Something that we're going to keep an eye on that could change that chart is the consumer, right? Manufacturing is staying busy because they're producing things that the consumer is buying. But what happens if the consumer starts to run out of money and they change their spending habits? So we want to look at what is the consumer doing and when will they start to change their spending habits. And what we have seen historically is once we fill up our credit card and we realize we can no longer meet the expectation to make the payments, maybe we need to stop spending as much money. So what we look at is the total household debt service ratio, which is of the money that we are bringing into the household and we're paying our bills, what is left over that has to go towards our personal debt. And we peaked right before the housing bubble at 13.3% of all of our income had to go to debt. We kind of, as a consumer, as a nation, we learned our lesson. We kept it down to about 10%. And when we hear it on the news, it sounds scary that, debt payments and debt values are at all-time highs, but so are income. So if we look at it as a percentage of disposable income, we're right back to our historic normal. Question is, where do we go from here? Another thing that we also want to look at is how much money, the bottom right chart, how much are our debt payments falling behind? So student loans are in good shape, but the question comes with, are people making their car loans and their credit card payments on time? And what we've started to see is delinquency on those payments start to increase a little bit, which means the consumer's probably strapped for cash, which might change their spending habits, which could trickle down, right? This is 3, 4, 5, 6 months down the road that could start to see some effects of that and the corporate profit bottom line when they announce their earnings.
Yes, the consumer's 2/3 of the economy, actually almost 70% at this stage of the game. So if they're running out of money, it will lead to a slowing in spending.
Yeah. So even with that, are we in a recession? Are we not? There's still opportunities in the investment market. So let's shift over to that. And we're doing these in some of our core investment models, our equity funds, our bond funds, and where do we have our clients' money? So when we're looking at our bond model, we want to look to the investment grade corporates, right? We can make some money here. We have really good yields. If you look at the yield to maturity off to the right side, we have 4 to 5.5% of just dividend income coming in with I would say about 1/3 of the risk compared to the stock market and the S&P 500. There's also some capital appreciation opportunities that if the Fed does eventually cut rates, or when they eventually cut rates, that can not only serve as a good boost for the economy, but for our bonds themselves, it can give us some capital appreciation on our prices in addition to our yield.
Yeah, the old saying goes, stocks are stories and bonds are math. And if we're collecting an interest payment and we're buying at a price below their maturity value, we know what the value is going to be at a specific time in the future. So the yield to maturity would indicate just buy it and hold on to it. That's the rate of return you're going to get.
Yep.
Very attractive. Mid caps, also a section of the market that looks very attractive at this stage of the game. We see in the little box there in the middle of the screen, mid caps are trading at about a 24% discount to large cap equities. That would be relative to the cost to buy the company's profits, called the price to earnings ratio. Mid caps are a good buy at this stage of the game. Now, we're not picking mid caps or small caps in our stock models, but we have them in our mutual fund models, and we are increasing our allocation into these areas where prices are very favorable. And anybody who is dollar cost averaging into those is taking advantage of buying at a very attractive price.
Yep. And then one more good investment opportunity that we are going to add into our existing investment mix, because we are looking to make sure we are long-term, well-diversified portfolios. We want to make sure that we add some alternatives into the mix, because the old adage of 60% stocks, 40% bonds, that gives you diversification. That has worked for the last 20 some years. If we look from 2000 to 2022, in the last decade or 22 years here, where interest rates are, we had good diversification between stocks and bonds. Now, with interest rates being higher, what we have seen, just like from 1966 to 2000, as interest rates were higher, bonds and stocks tend to trade the same way slightly. So what we want to make sure is, if the stock market's down and the bond market's down, what else can we invest in that would diversify your investments a little bit? And that is the alternative investment space. So we are adding that to our model allocations as well.
The math actually shows that not only does it reduce volatility of a portfolio, it also historically has enhanced the rate of return, which is kind of a double whammy, right? That's exactly what we're looking for, right? Less volatility and a better rate of return. It isn't always the case, but when stocks and bonds are positively correlated, we have to look for a third sleeve, if you will, a third alternative on things. And that would be the alternative markets, which is what we're expanding in our models.
Yep. So our takeaways here: the election concerns. My thought is kind of, why are we concerned about the election? The stock market's positive 10 out of the last 12 times, the average return being 10%. The bond market was positive all 12 of the previous 12 elections, average return of 7%. And stock market volatility is normal. We do expect it. We haven't seen much this year, so if we do see it, let's stay invested. Inflation, we're going to continue to see that hopefully trickle down a little bit and stay where it is, and slowly over time come down. As that happens, the Fed may adjust their view on interest rates. It's just a matter of when, right? Because they're going to adjust rates. It's just we have to wait until there's enough fracturing in the economics, the economy, to make sure that we don't have some sort of double dip recession like we saw in the 70s and 80s.
And having been doing this for 30 years, I really can't think of a time where we had so much feedback from the Fed, how much emphasis on what's the Fed saying, what are they doing. There's more information out there than ever before, and the word recession keeps getting tossed around. Remember, that's not me. It doesn't mean 2008. 2008 was a global financial crisis. A recession is simply a slowing in terms of the growth on the economy. That's what we need to get inflation down. Market opportunities at this stage of the game, as we've touched on, the investment grade model, bond model looks very good. Mid caps look very good, and alternatives look very good as well. I think a closing thought on this is that the amount of time that Derek and Alyssa and I spend working on all of this, keeping all this put together, trying to bring the message together for you is significant. As family members, it's like discussion over the dinner table, for heaven's sakes. But one of the things that I came across that I think is very, very appropriate at this stage of the game was a line in one of the articles that I read last week that said, it was from a portfolio manager, and what he said was essentially, the biggest mistakes that I've made in investments was due to a lack of patience. And the best moves that I've ever made came from having patience. And we all get impatient in a time where there's some concern about volatility in the markets and things, and we think we should do something right now. In fact, staying the course is a lot of times the best thing to do. So on that thought, thank you very much for your time. Thank you very much for tuning in to this message, and we look forward to talking to you very soon.
See you next quarter.